Jeffrey Sherman, who is the Deputy Chief Investment Officer at DoubleLine. And Jeffrey, no doubt you get the same question. Why are there so many Jeffreys around? And I know you've got a fair few over there at DoubleLine. So nice to see another Jeffrey, even though you're with a J rather than a G. Let's kick off here then. This view that bonds will outperform next year, very much predicated on the belief, really, that we are already headed into recession at this stage. Is the data supportive, though, of that case?
Well, if you look at anything that's a forward-looking indicator, it definitely is giving you signs of at least to be on alert for the recession. And we can start with the basics, such as the yield curve. The yield curve has been inverted. You know, if you think of the 2s-10 spread, which has a lot of respect with history and being able to kind of forecast that recession. It doesn't give you the timing of it, but it does indicate that there's stress in the marketplace. And so given the Fed's move last week, the entire yield curve is inverted at this point, even from the front end, from policy rates to the 2-year down to the 10-year. And so that is one of the indicators out there. If you look at the leading economic indicators, that's done by the Conference Board, which amalgamates a lot of forward-looking metrics. You're seeing stress in manufacturing PMI surveys. So when you start to take the data set, it does look that there is a high possibility of a recession in 2023. However, if you think about the data set that the Federal Reserve is using, a lot of that data is inherently lagged. And you think about CPI, right? Chairman Powell was referencing the year-over-year CPI prints still being in core north of 6% and in the headline numbers north of 7%. However, if you look at the last few months, you've started to see inflation cool in a meaningful manner. And so that's one thing where they're looking at that kind of year-over-year number. Lastly, and most importantly, and this is the one that still provides stability into the market, is the imbalance in the labor market. And we know inherently that labor is a lagged variable. Companies just don't let off their employees or lay off their employees because they think there's a recession. Usually the business is under duress, or you have this recession that where it's contemporaneous. And so even though there seems to be this imbalance in the labor market, it can change very quickly and very rapidly. So unfortunately, the data set that the Federal Reserve is using is typically more on those kind of lagged variables than necessarily on the leading side.
Looking at the inflation story, though, I agree with you that it does appear that inflation is rolling over and coming off the very high prints that we've seen. The problem is to believe that we're ultimately going to see bond yields trending a lot lower from here. Don't you have to take a view that the inflation challenge will be successful as far as the Fed is concerned very soon, rather than inflation staying around and being stubbornly persistent as we saw in the 70s?
Yeah, so there's a few things about that. One is that we're still going to have some persistence in core inflation, and even the Federal Reserve admits to that. Chairman Powell during this press conference was talking about he expects to see some of the data roll over in the housing market. They use something called owner's equivalent rent, which tends to be, again, a smooth and lagged somewhat variable. And so if you look at rent pressures today, even though the data set is seeing acceleration, the things you see that are posting from things like Zillow or these various like apartment listing areas, you're seeing that there is some relief there. Now, if you think about, the persistence, though, it still doesn't mean inflation's going back to the 2% target. And what we have at DoubleLine, our models say that, we think it's going to be around 4% or probably have a 4 handle on it next year. And again, a lot of that is the persistence of that rent component. But also, if you look at the contribution of services stripping out the housing market, what you actually find is that segment of CPI, MPCE, typically does not go negative, even when you're in a recession, because with the U.S. economy is so dependent on the services sector because of its consumption-based economy. And so those things will put some pressure there. But back to your original question about you saying that bond yields have to fall. Bond yields don't need to fall in order for investors to have a nice return at this stage in the cycle. And we've seen a nice run since the inflation data has cooled a bit. But the thing about looking at the bond market, it actually offers yield. And so, for instance, if you look at the 10-year Treasury today, which, from a US dollar investor standpoint is the benchmark for thinking about taking risk in the marketplace. That yield today is greater than what you saw on the high yield market, or at least the double B segment, the highest quality of those below investment grade bonds, about 16 months ago. And so all of a sudden, investors are able to find yield in the marketplace. And you can stress these yields in the marketplace as well when you get into corporate bonds and looking in the credit segments, where things like the investment grade corporate bond market yield around 5% today. You want to go to the below investment grade area, you can get 8.5 before default. So again, even if there is some sort of slowdown, with careful security selection and avoiding some of the more riskier segments of that market, there are some interesting opportunities. And then there's also things that are more specific to the US market, such as securitized assets, looking at the residential or the commercial real estate market, that are still very attractive as well. And so what you have is some of these segments of the market that are priced relatively okay relative to a recession right now. Some have gotten a little bit tighter. But in general, there are some opportunities where you're not predicated on this idea that yields must fall significantly in order to make a meaningful return.
I think you've said so many interesting things, and I was loath to interrupt. But Jeffrey, let me go to that corporate section as well. Then I want to talk about some of these securitized real estate assets as well. First, on the corporate side of things, we had a guest on from one of the big ratings agencies. And it was really hard to get anything out of him. I've got to be honest with you. And I won't say which rating agency. And so with default rates, well, we've got a fan chart. And it's going to be anywhere between 4% and 12% default rates as well. Now, as you know better than I do, that makes a massive difference to the viability of a lot of these companies and a lot of investment in corporate credit as well. So it's a big risk, isn't it? I hear what you're saying about some of the attractive yields in the corporate debt market, but there's enormous pitfalls when you've got that kind of fan chart of outcomes on delinquencies.
Yeah, I mean, that's not really a very good forecast when one says, well, it could be between 4 and 12%. I mean, as you're pointing out, there's a lot of variability there. But if you think about the health of corporate America, and yes, there is this potential for a recession as we're talking about. But when I talk about the health, let's talk about the deleveraging of the balance sheets that took place somewhat in some of these riskier areas of the market, like the energy complex. Let's also look at the amount of issuance of corporate debt in the last 2 years, or at least during 2020 and 2021, right? Remember how low interest rates were around the world. The US Treasury, the 10-year got down like 55 basis points or so. And so you saw a lot of corporate America be able to issue securities, not just at low interest rates, but for long tenors as well. And so what this did is this gave them the viability, at least to go through this part of the cycle. And so if you look through history, when there's a lot of issues with the corporate bond market, it tends to be related a lot of times to maturity walls. And what maturity walls are just saying how much debt needs to be refinanced in the system at this point in time. Well, there isn't a big maturity wall for the below investment grade world or the investment grade world for at least another 18 months. And that's more on the below investment grade. And the investment grade market has really kicked that maturity wall out. So if you look at the effective interest rate that corporate America is paying, it still is extremely low. So even though yields have reset, what that means is that interest coverage, again, assuming that you can keep your earnings, it doesn't have to grow in a meaningful manner, but because that interest coverage is low, it does make that a little bit more of an attractive opportunity, even given the idea that there's potentially this recession around the corner.
Yeah, that fascinating. Oh, genuinely, Jeffrey, we're both listening to every word of yours. Okay, can we go back to this real estate securitized side of things as well that you referenced in your previous answer as well? There's a lot of negative press at the moment, and I wonder if it is just negative press about the real quality of those securitized real estate offerings as well, when actually it's like the bad old days as well with some of these packaged up slice and dice debt offerings as well. Do you have the same concerns that we as journalists have, that actually it's the same old where unsuspecting investors are being repackaged stuff that isn't actually as good as it's being sold at?
Yeah, so I'm here to quell those concerns today. So there is a lot of headline risk around the real estate sector. No doubt there is pressure in housing in the U.S., house prices in the U.S. Okay, so let's just think about anyone who's taken out a mortgage in the last 2 or 3 years. If you've done this post-pandemic and not in the last 6 months, the price of your house is up relative to where you started. Now, doesn't say that prices cannot go down, and they're likely to go down. in 2023 in most regions. However, if you look at the gains since the beginning of the pandemic, a lot of these people are up 25, 30, 35%, even with some of the retracement we've seen. So there's inherent equity from that side. More importantly, the underwriting standards have changed very meaningfully here in the US. And so this means that people have to put the equity down. They have to actually make that down payment, the 20+% down on their real estate. So not only do they have embedded gains, they also have this skin in the game. Now, if you recall what I was saying about corporate America, and you think about the effective mortgage rate that people are taking out. So even though the headline mortgage rate today is about 6.5%, if you look at the entire industry right now, people who own a mortgage, the average interest rate is about 3.25 to 3.33%. And remember, in the US also, the majority of homeowners take out fixed rate mortgages. So even the reset interest rates, it doesn't do anything to these people's current payments. So what this means is that the quality is there. They don't have the interest rate risk. Maybe they don't have the mobility because house prices are declining, or they don't want to go out and take out a mortgage at a higher rate. But what this means is that the quality of the mortgage is good. The underlying fundamentals are still okay. And as long as you're not originating mortgages in the last 6 to 8 months, which, believe me, there has been a halt to almost all that activity because of how much pressure the affordability has been pressed down by both rising prices as well as these higher interest rates. So as long as you're avoiding that sector, there is a very high quality asset out there. And so if you think about the highest quality too, the US government guaranteed side of the equation as well, the spreads in that part of the market are some of the most attractive they've actually been in the last 10 years or so. And the reason for that is that you've had a big buyer step out of the market, the Federal Reserve. You've also had the banking system, which were big buyers over the last couple of years as they've had to free up liquidity for their balance sheets. They've stepped back a bit. And so what that's done is it's created good opportunity. So you can mix a government guaranteed side of the equation with the private label or the non-government guaranteed side of the equation. And together, those portfolios can yield something on the magnitude of 6%, lending to the highest quality borrowers with significant skin in the game.
Jeffrey, just before we let you go, and very briefly, because we're running towards the end of the program here, where do you think there's the biggest valuation or misvaluation problem in the financial plumbing at the moment that needs resetting? We've sat around this desk a lot this year talking about private equity and the problems in the private asset market. Is that where the source of trouble is going to come from, or are we looking in the wrong place?
Well, I don't know if it's a source of trouble, but what it is in my career, and it's only been 2 decades, it is the biggest disconnect we've seen between the public and private markets, and that's as a whole. That's private equity juxtaposed against public equity. That's private credit against the public debt markets as well. And so the valuation gap between those two areas is significant. And so they need to converge at some point in time. Now, again, it's not that private equity or private credit is doing something they didn't tell you. We know about the lags. We know about the staleness of prices. It's just the rapid declines we've seen in the public markets, and you haven't seen that reset to private. So yes, there are problems with the private market. It needs to be marked down. The other thing you have is, because of that, you have a lot of institutional investors now that have too much exposure to the private markets because, one, again, the prices aren't really down. Let's call them flat, in some cases up, where the public markets are down. So that inherently puts you a bit off sides. But secondly, there's been significant capital calls this year to the private sectors of the market. And so they've been accelerated on a faster drawdown than you've seen over the last 5 to 10 years. And so there's been this over allocation to the sector because the capital calls have been slow. Now all of a sudden the capital calls have sped up. Plus you do this with this valuation gap between public and private markets. So the good news about private markets is investors can't sell their positions. So you don't get this forced liquidation. But if we continue to have stress in the public markets, it makes the public market significantly cheaper, and that convergence must be by private coming down. So again, it's not that I think it's a harbinger of some negative thing to come into the market and causing stress. Remember, it's kind of held in more powerful hands. It's held in more long-term investors' hands on the private side. And by the way, you really can't get out of those private investments by definition. And so all it is a disconnect. And so what we'd advise is that anyone seeking to put money into work in any of these markets. You look in the public markets today because you know the price, you can see the valuation gap between those areas, and the public market just offers significant value, whether that's credit or equity.
We've got to say goodbye, but thank you so much for that sound advice for our audience. Jeffrey Sherman, Deputy Chief Investment Officer at DoubleLine.